Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, March 30th, 2026. Before we look ahead, let's briefly recap how markets closed on Friday. It was a weak finish to a difficult week. The Dow Jones Industrial Average closed at 45,166. The S&P finished at 6,368. The Nasdaq led the downside, falling 4.55%, while the Russell 2000 lost almost 1.8%. Friday did not look like capitulation. It looked like continued defensive positioning with very little conviction on rebounds. Brent crude also rose at $112.50 a barrel, while WTI nearly touched 100 intraday, keeping energy at the center of the macro story. Now, as we begin a new week and a new month, the question is no longer whether volatility has returned. The question is whether this becomes a deeper correction or stabilizes into tradable range. Here's what I'm watching this week. First, market structure and key levels. The Dow is sitting just above 45,000, and that level now matters psychologically as much as technically. If that floor holds, we could see a short-term relief bounce from oversold conditions. But the market is also looking for something more specific, a higher low. If buyers cannot defend support and establish that kind of pause in the downtrend, then this starts to look less like a pullback and more like correction with momentum behind it. Second, energy and geopolitical risk. This remains one of the most important variables in the market. Oil is no longer just a headline. It is a live input into inflation expectations, consumer pressure, and Fed psychology. Over the weekend, the Middle East conflict remains a source of supply and shipping anxiety, with markets focused on the Straits of Hormuz and broader regional escalation. If oil stays elevated or moves higher from here, it becomes harder for equities to stabilize cleanly. Third, Powell and the macro calendar. Monday begins with Chair Powell speaking at 10:30 a.m. Eastern, and I think investors should listen with a 3-point watch list in mind. Number one, does he sound like the Fed will look through this oil shock or treat it as a real inflation inflection point? Standard Fed doctrine is usually to look through temporary energy spikes, but this market is worried that $100 plus oil is no longer temporary. If Powell stays focused on core inflation and reinforces the March 18 projection of one cut later this year is still plausible, markets may take that as reassurance. But if he suggests energy is threatening to unanchor inflation expectations, the higher for longer sell-off could intensify. The Fed's latest projections lifted both PCE and core PCE for 2026 to 2.7%, which tells you inflation is already not where the market wants it. Number two, does he emphasize labor market chills or energy heat? This is where the stagflation tension shows up most clearly. February payrolls came in at negative 92,000, which points to a labor market that may be more cooling than expected. If Powell leans into downside employment risk, that could hint that the Fed is still open to easing later this year despite oil pressure. If he largely ignores the job slowdown and keeps returning to inflation and crude, expect markets to hear that as a more hawkish signal. Three, does he offer any guidance that becomes the market's anchor into Good Friday? Because the jobs report arrives Friday while the equity markets are closed, Powell's tone on Monday may become the main policy anchor that investors carry through the week. Listen closely for any discussion of neutral rate thinking. Recent reporting suggests some Fed officials are increasingly viewing the current policy range as closer to neutral, while also questioning whether structural forces like tariffs, energy, and AI-driven capital spending may be pushing that neutral level higher. If Powell hints that neutral may be drifting up, Treasury yields could respond quickly, and that could be especially hard on the Nasdaq. A pro tip here. Watch the 2-year Treasury yield during his remarks. If that yield starts pressing back above 4%, it's a sign the bond market is becoming less willing to believe in near-term cuts, regardless of how carefully Powell phrases it. Beyond Powell, Tuesday brings consumer confidence, and this report has extra weight for the week. If gasoline prices are biting and confidence drops sharply, that would be a sign the energy shock is moving from commodity screens to the real economy. Wednesday is the biggest data date of the week, with ADP, retail sales, and ISM manufacturing. Then Friday morning brings the jobs reports, which is still the ultimate heat check for the Fed, even if markets have to digest it through thinner holiday liquidity first. Fourth, leadership and rotation. Technology led downslide last week, and that matters because when tech weakens, the broader market loses its engine. We're seeing a valuation reset where growth is no longer being bought at any price. At the same time, I will be watching whether industrials, materials, and energy begin to hold up better. That would not just be a safety trade, it would be a commodity linked hedge, a shift towards sectors that may actually benefit from a $100 plus oil environment and tighter real world supply conditions. If those groups begin to outperform while tech remains under pressure, it would suggest the market is not just falling, it's rotating. And that is an important distinction. One final thought. The market is now in a show me phase. Expectations matter less here than liquidity, energy costs, and whether buyers can defend support. There may absolutely be a bounce after a week like the one that we just had, but unless oil stabilizes and Powell sounds comfortable and the market can carve out a higher low, any rebound could still be fragile. Stay disciplined, my friends, stay focused, and elevate your legacy.